Hey there guys, welcome back to another video. In this video we're just going to be looking at accounting 3.4, which is an internal, which is typically a report looking at investing into a company for a potential shareholder. This company that we're going to do is going to be Michael Hill, and we're going to look through kind of how to go through and answer one part of the report. The report's going to it's going to include a section on profitability, liquidity and cash management and market analysis. We're just going to do a model answer and kind of go through some tips and tricks just for one section on profitability, on our net profit percentage. And yeah, so we'll get into that now, guys. So like what I was saying just before, guys, there's going to be a few different sections that we're going to want to look at for different parts of our report. I'm only going to go through a model answer for one, obviously because you guys need to do this yourself, but just to kind of give you a few tips and tricks and show you the structure that you need to be working on while you're doing it. So I kind of split this into three areas that you need to do, and a section on profitability, a section on liquidity, and a section on market analysis and the cash flow. So for the profitability, I'd recommend you guys do a section on gross profit percentage, net profit percentage, total expense percentage, rate of return on equity, and the return on total assets. So those five there. For the liquidity analysis, I'd recommend you guys do a section on the current ratio, the liquid ratio, the gearing ratio, the equity, and the equity ratio. Those four. And then for cash management and market analysis, some on the cash flow adequacy, the cash flow to operating revenue, the share price, the dividends per share, the dividend yield, the earnings per share. Those three are quite repetitive. The price earnings ratio, net, and the net tangible assets per share. So I'd recommend writing those down, guys, and just going through them periodically one by one. In terms of what all those things mean, check out my video on 2.4. Which some of you guys will have looked at last year. Essentially, that video just goes through what a lot of these individual things mean, such as your current ratio, looking at your liabilities and your assets, your current liabilities and current assets. Anyway, guys, so we'll get on into doing a bit of a write-up here. Now, what I'm going to look at is our net profit percentage. We're just going to go through that question there, and we're going to go through the format of that one there. So we'll write that down in here. Make it a bit bigger. Net. Okay. So now, guys, if you're allowed to use AI tools to write your report, I would really highly recommend using them. And I'm going to talk a little bit about how I'd recommend to use them as well. So over here, like we said, we're doing Michael Hill. So I've taken Michael Hill's annual report. I've downloaded it off my computer, all 112 pages. Now, there's quite a lot of information in here. If we just look through here, all the different information that they're giving, and it would take quite a lot of time to manually go through all of this here. So what I'd recommend, guys, is to upload it to ChatGPT or another AI tool that you guys like to use and ask it some questions to help understand it a little bit better. Don't get it to write your report itself, because it's actually not going to write you a very good report. But if you're prompting it correctly, you can get a lot of knowledge from it, as long as you're allowed to do it, of course. So we'll start off with, so as we're doing our net profit percentage, guys, coming back to level 2 here, we're remembering that our net profit percentage is given as our revenue minus our costs, so our net profit divided by our revenue times by 100. So what I'm going to start off with here is just asking the AI here to calculate, to just tell me where in the report the net profit is, or the net loss for the year. So giving sources from this report, tell me where net profit and sales figures be found. So guys, another thing, never ask it to give you the outright numbers, because it almost always gets them wrong. Just ask them where in the report to find them. Okay, so what we're looking for is where our actual financial statements are. So if they say here, page 58 and onwards is our financial statements section. So we'll come over here to our financial statements and we'll put page 58 in over here. Okay, so starting off with, guys, for profitability, we are going to be looking at our statement of profit or loss. Income statement is what it's called at NCA. For our liquidity, you'll be looking at your statement of financial position, which you guys will also remember, and then a little bit of the stuff in equity as well for our market analysis, looking at the dividends. So coming over to our statement, we know that just looking here, our profit or loss for the year, remembering if it's a loss, it will be in brackets. Our loss for the year in 2024 was 479,000. Okay, so we can put that down into our calculators now. Negative 479,000. I'll put that into mine. And the sales for the year was all the way up at the top. So revenue contracts from customers, 644,929. Okay, now we're going to times that by 100. And it's going to give us negative 0.07%. So quite a low figure. Essentially, they just broke even. That's what that $479,000 loss means. Guys, just remembering that these zeros up here as well mean that there's 3 zeros on the end of every figure. So they made a loss not of $479, $479,000. So what we're just going to do, guys, is we're just going to write that in there for our notes. 2024 negative 0.07 negative. Coming over to 2023, guys, just in our column here on the right, we know that our profit for the year was 35,182,000, but we'll just put 35,182, and our sales for the year were 629,562. All right, perfect, and that's going to give us, we'll times that by 100, and that's going to give us a profit margin of 5.58%. So we'll just round that up to 5.6%. There's a percentage point in there. 5.6%, not bad, not awful. Yeah, so when we're writing our report, guys, what we want to start off with is just kind of explaining the numbers, what they mean. Then we want to go into explain and just kind of talk through what could have caused those things. And then finally, I'd also recommend, if you're aiming for those excellence grades, just to compare them to a few market competitors. Michael Hill doesn't have many, but maybe if you're doing something like Briscoe's, you could compare it to a company like Hellenstein's or Kathmandu, just as an example. But anyway, guys, we'll get on into our net profit percentage report here now. So remembering back from level 2, guys, our net profit percentage is showing how much of every $1 for every $1 of sales, how much of that remains after all the expenses are paid, and that's your profit after interest and tax. So as we made a loss in 2024, none remained, and we lost some money, some of our assets from our retained earnings. So anyway, so we'll write this out here, guys. So so this figure shows how much for every $1 of sales for the Michael Hill Group. Remained after all expenses, including interest and tax, were paid. So then now what we're going to do, guys, you've kind of put out that opening sentence explaining what it means. Now we're going to give you the two figures. So in 2023, the net profit percentage was 5.6%, and in 2024, where the Michael Hill made a loss, right? Just mentioning that before. The net profit percentage was 5.6%. Right, so it was a bit of a, sorry, not 5.6%, it was negative 0.07%. So pretty bad, guys. Very downward kind of trend. Yeah, so from here, guys, we're going to talk about what the trend is doing. It's decreasing, which is not great, especially now that it's negative and they made a loss for the year. And then what we're going to do is we're going to kind of go into using our AI tools to kind of help us find out what's changed and try get a little bit more explanation behind it, and then verify that ourselves. So making sure that you're not just asking it to do it, what happened, and then just pasting it into a document. I wouldn't recommend that because quite often you're going to struggle with some continuity errors, and a lot of the time it's going to generate kind of false information. Moving on here, we're going to look at, we're just going to explain the trend here. Okay, so this is this decreasing trend is very poor for the Michael Hill group. As it shows an increase in expenses and less money that could be paid out to shareholders. Okay, so that's all they're kind of looking for. The main thing that they're after, guys, is just looking at the reasoning for why this happened. Okay, so we're going to go into that now. So just looking at here, guys, before we use any tools and stuff like that to help us kind of make a little bit more sense of what happened, what we're trying to look for here is where the large changes were. Okay, where maybe income decreased quite significantly, or maybe an expense increased quite significantly. So starting off with here, guys, looking at our very first line, which is our revenue, it actually increased by quite a bit. So originally it was 629,562,000, and in 2024 it was 644,929,000. So that's an increase of 15 million, which is not bad. And that is most likely just from some kind of more inflationary stuff. But again, we can use our AI tools to help us find out a little bit more about that. Moving on, guys, just looking to see where our big figures are. So our cost of goods sold saw quite a big increase. Okay, so it went from 225 to 254, which is roughly a $29 million increase. And that increased substantially more than our revenue with the contract from customers. Okay, so immediately from there, guys, we're just going to take some notes here. Cost of goods sold, and now I'm sure there's going to be a reason for why that is, and this is something that we can use our AI tools for to help us out with, if you're allowed to use them, that is. Again, guys, looking here at our employee benefits expenses, this has increased quite dramatically as well, from 168 million to 182 million. That's an increase of roughly 14 million. So we're going to put that down as well. Employee benefit expense, 14 million. Okay, moving on to a little bit further down. There's been a bit of an increase in occupancy costs. Not too much though, so I don't think we'll go into that fully. Our marketing expenses have actually decreased, so we don't need to worry about that. Again, selling expenses, there's been a bit of change, but nothing real, no cause for concern there, just a $2 million change. There's been quite a big decrease in the impairment of reversal of property, plant, equipment, and other assets, but again, the change has been pretty insignificant in the grand scheme of the income statement, so we're not probably going to touch on it. This here looks a little bit bigger, so we've had a bit of a change in our depreciation and our amortization expenses, sorry, of around, 11 million. So we'll definitely note that down. So depreciation and amortization expense increased 11 million. Okay, moving on. Very little change on the loss of disposal of the PPE. Administrative expenses, relatively similar, likewise with other expenses, and a little bit of an increase in finance expenses. So finance expenses have increased by about 5 million. Okay. So now, guys, what I'd recommend, or what we can do, is we can use, so first of all, if you're not allowed to use AI tools, you're going to need to go through and read the notes. And you're probably going to need to read the entire report to try and get more of an idea. But with our AI tools, we can ask a few questions. Okay, so we're going to come over and use our AI tools here, as long as we're allowed to. If not, you're going to have to go through the notes manually. We're going to start off by asking why that cost of goods has increased so much. And what we're going to do, guys, is we're just going to get it to prompt us to look in a place to verify that. If you ask it just a question outright, it can quite often generate false information from the report. So it's really important to double check it. But doing this, we can get a lot more information. We can really speed up our process. So why has cost of goods sold increased? More so than revenue. Please explain why. Okay, nice, good long prompt, guys. I'd recommend getting a nice, good prompt for a question like this. So we'll see what it has to say here. Okay, so here it hasn't given us too many page numbers, so I'll say we want to go through and check it, so I'm going to say give me page numbers. Or say give me page numbers for those claims. Okay, so we're starting off with here, guys. We're looking at the higher input costs. So that is included in our cost of goods sold. Remembering our cost of goods sold is the cost to make to get those goods. So diamonds, gold, other precious metals that will be used in Michael Hill's jewelry. So we'll have a look at the CEO's message here on page 8. So we'll just come over here, page 8, and we'll see what he has to say here. Alrighty, guys, just reading through. Okay, so down at the bottom here, we see that the CEO says the price of key raw materials, gold and diamonds, continued to elevate to record highs, placing pressure on gross margin and prompting some repricing across the business. With this in mind, the business, blah, blah, blah. So we know now that the CEO said, we'll come here, take a few more notes. CEO has said diamonds and gold increased in cost. Increasing COGS, which is short for cost of goods sold, decreasing profit. Okay, so now what we can do, guys, is we can go back to our AI tools and we can, now we kind of know the reasoning for this first one. It's because cost of diamonds and gold have increased. We can use our AI tools to find out why the diamonds have increased so much in cost. Okay, guys, so it's saying here the reasoning behind it is because of some shutdown of some mines, some sanctions on Russia, which I think is going to be the main thing, because that decline in global diamond production will probably be because of the sanctions on Russia. And we can go through and check that, guys, but we're probably already going to know that the sanctions on Russia are real because of that war in Ukraine, so we probably don't need to go through and verify that. So what we'll do is we'll just put in here for our notes, war in Russia, Ukraine, sanctions caused sanctions on Russia, which accounts for 35% of market, less supply increases, which increases price. Nice, guys. So that's that first point here done. So we'll go ahead and we'll kind of put that into a little bit more of a proper sentence. So several factors. So because we're going to be going through all four, so we'll start off. So several factors caused profit to decrease for Michael Hill in the 2023 to 2024 financial year. The first of these was an increase in cost of goods sold, which, according to CEO, and we'll just find his name really quick here, guys. What's his name? Again, guys, just it's good to have some references to people's names. Can't seem to find it. What we'll do, guys, is we'll just go Michael Hill, CEO. Okay, Daniel Bracken. CEO Daniel Bracken was caused by an increase in the cost of diamonds and gold. These increases were due to Russia's invasion of Ukraine, which resulted in Western sanctions. Actually, we'll come back here, guys. We'll just say Russia accounts for 35% of the global diamond market. So when Russia invaded Ukraine, the Western sanctions reduced the supply of diamonds, up the price. Alright, perfect, guys. That is that first one there done. We can decrease these kind of little notes we've got here, and we'll also come through and we'll decrease that one there. Now what we're going to do is we're going to go on to the employee benefit expenses. So explain the increase in employee benefit expense. So guys, just as it's going through this here, one thing we also could potentially mention is with the war in Ukraine potentially coming to an end, and President Donald Trump talking about potentially taking off some of the tariffs on Russia, we could actually see a decrease in tariffs and sanctions, and from there we could see a decrease in cost of goods sold and a more healthy profit margin. So we'll just chuck a little sentence on there at the end. So President Donald Trump has indicated the war in Ukraine will likely end soon. Obviously, there's still a lot of uncertainty on his promises, but just for this, we're just going to assume that we'll take his word for it. President Donald Trump has indicated the war in Ukraine will likely end soon, and is keen to drop sanctions against Russia, which means in the future cost of goods sold could decrease, and profitability could increase. All right, nice. Just that little bit on there. So coming on to the wage increase here, guys. It's telling us to look here at page 74. Okay, so we'll go on to page 74 here. Okay, so this is looking at, remembering our employee benefits increased by 14 million. Okay, and we can see that roughly 14 million. So coming back to our AI tool, we're not too worried about. Oh, maybe we are worried about this. So we'll just prompt it again. So explain. So again, guys, don't want to sound like a broken record here, but always really good to prompt it to give you references. It makes it a little bit more reliable, the data it's going to give you. Okay. So we know during the year, guys, I did have a bit of a read of the Michael Hill financial report beforehand, that they acquired a new business in Australia, which included 26 stores and 350 team members. So obviously there's going to be a bit of increased cost onboarding them, integrating the systems together, and stuff like that, which would come under employee benefit expenses, and it would also include kind of getting them on pension plans and stuff like that. So we'll go ahead and we'll put that in. Additionally, another factor that contributed to the decrease in profitability was an increase in the employee benefit expenses by roughly 14 million. This was primarily due to the acquisition of a new company. Spell that correctly. Acquisition of, I think it's Bevel, is how you spell Bevel, which had roughly 350 new employees. It can be expected that these costs will remain this high unless there is. Right, guys, so they've taken on those stores. Those employees, they're not going anywhere. They're going to keep getting paid. They're going to keep getting their employee expense program. So the expenses are probably going to stay around there for now. Okay, so coming on to the increase in depreciation and amortization. Amortization, guys, is just depreciation for intangible assets, like things like patents or goodwill or something like that. So there was an increase of 11 million there, and we're just going to ask what caused the increase in really well. This one's a little bit more tricky, guys, so we'll go through this one now. Yeah. So it kind of comes back to this takeover of the new stores, of the Bevel stores that they've bought. So when they lease the new stores, their leases are now considered assets. So when they lease those new stores, they've got to depreciate a few of those. See if I can get rid of that. No, I can't. They've got to depreciate a few of those. And what that means is that depreciation is going to increase by a lot because they're leasing all these new stores, all these new Bevel stores. So that's essentially the reason. So we'll write that in here now. So additionally, depreciation and amortization increased by roughly 11 million. This was primarily due to Bevel, like we just talked about before, guys, and the new leases that were signed. These leases are right-of-use assets, like we were just talking about before, guys, meaning they're depreciated, which caused the majority of the increase in depreciation. Alrighty, guys. Just for this last one, I've hit the free plan limit, so I'll just go through and show you how to do it manually. So we'll just look at the finance increase expenses. So what I'm going to do is we're going to go back to our financial statements, which is here, and we're going to just look at finance expenses, and just here we're looking at the notes here, guys. So it says F1, so we're going to go look for F1. What we can actually do is F1, is it? Oh, F10, alright, we've skipped it. F8, F8, F7, F4, F3, F1, here we go. Okay, finance costs, that's what we're interested in. So, interest on lease liabilities has increased a decent chunk, and bank and interest charges have also increased. And there's another note there. We won't go through and look at that though. Okay, so bank and interest charges. The reason that would be increasing is because of more loan, or because interest rates have increased. More loans, sorry. And then the lease liabilities, you're more looking at stuff like cars or something like that. We'll focus on the bank and interest charges. Finally, finance expenses have increased by roughly 5 million. This is primarily due to the increase in bank and interest charges, which has come from, we might actually just find out, we'll just put it back in. Oh no, we can't do that. Okay, well we'll just write, so with bank and interest charges, guys, the reason that they've probably increased is because of maybe loans coming into a new term where they just are no longer a fixed interest rate. We know that interest rates in Australia are decreasing, and were they decreasing in 2023? We'll check. Australian interest over time. Let's have a quick look at this here, guys. Okay, so they actually probably were still increasing. Remembering, guys, this report is 2023 to 2024 financial year, so that's why there would still be an increase. They're coming down now, 2025, touch wood, but we'll say that for now. So this is primarily due to the increase of bank and interest charge, which has come from increasing interest rates from the Reserve Bank in New Zealand and Australia, New Zealand and Australia. New Zealand and Australia, causing non-fixed interest rates to increase. Non-fixed just meaning, guys, that they're floating, so they're just whatever the OCR sets them at. Non-fixed interest rates to increase, decreasing profit. In the future, these will likely decrease, and we could see okay. Alright guys, so we've kind of gone through and we've explained all the different reasons. So what we're just going to do to wrap up with is just do a little bit of a comparison to a few other businesses, okay? So we'll just, what's another business? We could potentially have a look at Hallenstein's. So we'll just look Hallenstein's financial statements. Alrighty, we'll just download those, open those in a new page, yeah. Okay, so we're looking at for their financial statements. Okay. So over here, the net profit was 34,486,000. So what we'll do is we'll put that in our calculator, 34,486 divided by their sales revenue, which was 435,635, and that was 0.079, so 7.9%. Compared to similar businesses, publicly traded in New Zealand and Australia, such as Hallenstein's Glassons, which had a profit margin of 7.9%. The Michael Hill Group is doing poor. However, in the future, I believe we could in the future we'll say in the future there will be opportunity. There is an opportunity for expenses to decrease and profitability to increase. Alright guys, almost done. Just one last thing is, often for this test you'll be given a certain investor. So for this example, I've just picked a 18-year-old guy who's young, just inherited some money, he's got a high tolerance for risk, and he really just wants to make lots of capital growth. So this would work quite well for him, because there is a chance that Michael Hill is like a decent chance that Michael Hill's expenses will decrease. They're going to be able to turn their company around. So what we're going to say is, this fits your risk portfolio. This fits your risk portfolio as there is a large chance for the business to turn around. Just put that in brackets. To turn around and see large growth and profitability, likely resulting in capital growth. Capital growth meaning the value of the share price is going to increase. Alrighty guys, so that is, it's doing poorly. So that is kind of what we're looking for just one of our sections. Now, at the start, remember I went over the sections we'd recommend. You don't need to do all your sections that long. So now that we've kind of explained the reasons behind profitability, we don't really need to go into it for every single gross profit or expense percentage, because we've kind of explained the reasons behind it. We can just refer back to this and just do a little bit more of comparing it to a few other businesses. Yeah, so I'd really recommend just kind of following that format and doing one really good example for each kind of the three sections. And again, guys, if you're allowed to use AI tools, definitely do. They're a great tool, but don't just copy whatever it tells you, because it's probably going to give you the wrong information, so you've got to use it wisely. Alright guys, I hope you enjoyed the video. Like and subscribe, and have a great rest of your day.